Welcome to the deep dive. Our mission, as always, is pretty simple. Take these dense financial reports, these corporate presentations, and boil them down into, well, actionable intelligence for you.
Yep, clear insights from complex data.
And today we're looking at a really interesting case, a bit of a balancing act, you could say. We're diving into the Q2 and H1 FY26 results for Supreme Petrochem Limited SPL.
Yeah, this is a crucial one because SPL is really pushing forward with some major strategic expansion, but they're doing it right into, well, the face of a pretty severe market downturn. So we really need to unpack how their, fundamental strengths are stacking up against these really powerful external forces, especially in the commodity markets.
Absolutely. And just to set the stage, when we talk SPL, we're talking about the clear market leader here in India for styrenics. They've got, what, over 50% market share?
Easily. And polystyrene, expanded polystyrene.
Yeah.
Yeah, they dominate.
And their financial footing starting out pretty enviable.
Oh, enviable might be putting it mildly. I mean, fundamentally, the company's debt-free. That's huge.
Right.
As of end of September 2025, they were sitting on an investable surplus north of 522 crores INR.
Wow.
And what's really key here, I think, is the discipline. All their significant capital spending, their CapEx, it's all being funded internally.
So no borrowing needed?
Exactly.
Yeah.
And that just puts them in a completely different league, doesn't it? They can invest aggressively without constantly looking over their shoulder at rising interest rates.
Okay, so let's dig into how they use that stability because, like you said, they're not just sitting on cash. They're building differentiation, and sustainability seems to be a big part of that strategy.
It really does. And for a chemical company, that kind of commitment, it's become a real competitive edge.
How so? Is it measurable?
Oh, yeah, very much so. Operationally, look at this. Zero liquid discharge at both main plants, Amdoshi in Maharashtra and Manali Newtown down in Chennai.
Zero liquid discharge. That
That's
sounds significant.
It is significant. It's costly, takes real commitment. But, for their big industrial customers, these kinds of standards are becoming table stakes, almost non-negotiable.
And energy, too, right? Their power mix is changing.
Dramatically, yeah. They're currently meeting about half, around 50% of their total power needs from renewable sources.
50%? How?
Well, there's a big 12.5 megawatt solar plant that's a joint venture with Tata Renewable Energy. Plus, they've got extensive rooftop solar installations across their sites.
Okay, 50% renewable. Put that in context for us. What does that actually do?
Well, think about the carbon footprint. That kind of commitment, it likely offsets hundreds of thousands of tons of potential CO2 emissions every year. It's not just greenwashing. It's a real measurable commitment. And it future-proofs them against tighter environmental regulations down the line.
And that focus seems to extend to their products as well. They make that XPS foam board.
Right, the extruded polystyrene insulation foam board. They're India's first and still the only manufacturer.
And why is that important?
It's crucial for building insulation, right? Meeting modern energy conservation codes. Efficiency. It ties right back into that sustainability theme.
Got it. And are they tackling the plastic waste issue too?
They are, proactively. SPL is putting effort into promoting the recycling of post-consumer expandable polystyrene. That stuff's often tricky to handle, So they're working with several NGOs trying to, close the loop on their own materials. It's part of that whole circularity push.
So you have this stable base, the green investments, the strategic product focus. And that translates into shareholder value too, right? There was news from the recent board meeting.
Absolutely. October 24th, they moved quickly after the meeting to declare a pretty hefty interim dividend, 125%.
125%. What's that in real money?
That's INR 2.50 per equity share. Base value is RS2, so yeah, quite strong.
And that shows confidence, even with big investments happening.
Exactly. It shows the core business is still throwing off enough cash to reward shareholders. And again, that connects right back to being debt-free.
Huh?
They can afford these payouts without feeling financial strain.
Okay, so the dividend keeps shareholders happy in the short term. But the real long game, the big bet they're making with all that internal cash, that brings us to the main event, strategically speaking.
Right. The big leap.
Their move into ABS, acrylonitrile, butadiene, styrene. That's a step up the value chain, isn't it?
Oh, absolutely. This is the strategic headline from this period, no question. Commissioning the first line of their mass ABS plant at Amdoshi.
Okay.
That 70,000 metric tons per annum TPA of new capacity, it just started production back in September.
70,000 tons. That's substantial.
It is. And it's not just about volume. This represents a technological jump for the whole Indian market, really.
How so? They're using technology licensed from Versalis in Italy, right?
Yes, from MS Versalis SPA. And the key thing is this is India's first continuous production process for ABS.
Okay, continuous versus batch. Why does that matter? What's the edge there for SPL?
It really comes down to consistency and purity. And those translate directly into, well, better performance and potentially cost savings for their customers, especially high-end manufacturers.
Persistency.
Like exceptional lot-to-lot consistency. Think about automotive parts. You need reliability, new zero failure rates. Continuous process delivers that much better than traditional batch methods.
Okay, makes sense. And they also mentioned things like lower base color and more efficient coloring. Why is a whiter starting material a big deal?
That matters a lot. Two main reasons: premium feel and cost.
Okay.
If your base ABS is already cleaner, whiter, it takes less pigment, fewer expensive additives to get those really vibrant colors or those glossy whites you see on, say, high-end appliances or fancy e-scooter bodies.
Right, so it lowers the input costs for SPL's customers making those premium goods.
Exactly. It helps them achieve that premium look more efficiently.
They also listed better UV and thermal stability, lower VOCs, higher melt strength.
Yeah, and again, these aren't just tech specs. They're commercial advantages. Okay. Better UV and heat resistance means parts last longer outdoors. Critical for helmets, car parts under the Indian sun.
Makes sense.
Lower VOCs, volatile organic compounds, that's essential for car interiors, medical devices, places where air quality matters and is often regulated. Higher melt strength helps in processing complex shapes.
So this high-quality ABS is really aimed at those more sophisticated, higher-margin markets. Automotive, appliances, medical.
Precisely. That's the strategy.
But launching 70,000 tons of new capacity right now, with the economy looking shaky, is this the smartest timing, or are they just betting the cycle turns fast?
Look, it's definitely an aggressive move, a bet, you could say, but it's a bet they can make because they have that debt-free foundation we talked about. By launching now, even in a downturn, they can get the plant running, get products qualified, maybe grab some early market share while competitors might be pulling back. They're positioning themselves to capture demand the moment the cycle recovers.
Using their financial strength to buy future share.
That's the play, I think. And this expansion, it bumps their total capacity at Amdoshi up significantly to 512,000 TPA overall. This new ABS line slots in alongside their big polystyrene and EPS lines.
And it seems like they're building an ecosystem, too, with that subsidiary X-Mold Polymers.
Right. MS X-Mold Polymers. That's their subsidiary making engineering polymer components, selling directly to those auto and appliance makers they're targeting with the new ABS. So yeah, it looks like vertical integration is part of the plan too.
Okay, so we've got this picture. Rock-solid finances, smart green initiatives, aggressive strategic expansion into high-value ABS. Sounds great.
Yeah, the long-term picture looks promising.
But now let's pivot to the harsh reality check, because the numbers for the last 6 months, H1, FY26, they tell a very different story. A painful one in the short term.
They really do. The headline figures show a pretty significant contraction. Operational revenue, for instance, dropped sharply, down 19.2% compared to last year. Came in at 24,867 million INR.
Almost 20% down on the top line. Ouch. What about profit?
Even worse. Net profit, the PAT, took a much harder hit. It collapsed by 39.2% year over year, down to just 291 million INR.
Wow, nearly 40%. That's a massive drop.
It is. And even the core profitability metric, operating EBITDA margins, they shrank too. Dropped 157 basis points down to 7.73%.
Okay, so revenue down, profit way down, margins squeezed. Did volumes hold up at least?
Nope. Volumes were also down, though not dramatically. Total sales volume slipped 2.3% in H1 this year compared to H1 last year.
So less stuff sold and much less profit made on each bit of stuff sold.
That sums it up pretty well.
Which raises the big question. Is this an SPL-specific problem, something they did wrong? Or is it just the market dragging them down?
Well, the company itself points very clearly to external factors, powerful ones. They actually laid out several specific reasons for this adverse impact.
Okay, let's hear them. What did they blame? First up.
Weather. Simple as that sometimes. They cited the extended, heavy monsoon season across key parts of India.
And that dampened demand how?
Weak demand for cooling stuff. ACs, refrigerators. If it's raining and cool, people aren't rushing out to buy air conditioners. And if they're not buying those durable goods, they're not buying the polymers SPL makes that go into them.
Makes sense. What else?
Second, a bit of policy uncertainty. There were advance notifications or maybe just strong rumors about GST rate cuts coming for durable goods.
Ah, so people held off buying.
Exactly. Consumers, figuring prices might drop soon, just deferred purchases. Put a pause on the market.
Okay. Weather, policy.
Yep.
Anything else?
Yeah. Third, they pointed to the global picture.
Mm-hmm.
Just generally subdued business activity in major economies overseas. Plus, changes in trade flows, partly due to new U.S. tariffs impacting global supply chains and sentiment.
Right. Those global headwinds we keep hearing about.
Mm-hmm. They affect confidence, maybe some export viability for SPO's customers.
Okay, so weather, policy, global slowdown. Those definitely explain the volume drop, the 2.3% dip.
Mm-hmm.
But that huge 39% profit collapse, the margin squeeze, there has to be more to it.
There is. And this is the absolute crucial factor, the dominant reason, especially for the margin hit. Anyone watching the chemical sector needs to understand this.
Yeah.
Commodity price pressure.
Okay, let's unpack that. Commodity price pressure. What specifically?
Styrene monomer, SM, that's SPL's main raw material, their primary feedstock.
Right.
And the price of SM basically fell off a cliff. It dropped significantly. Went from around US $940 per metric ton at the end of June 2025.
Okay.
Down to currently hovering around US $800 per ton.
Wow. That's a big drop, like $140 a ton in just a few months.
A rapid and really profound drop, yeah.
Okay, but hang on. If your main raw material gets cheaper, shouldn't that help your margins? Why does a falling SM price crush SPL's profits? It sounds backward.
It does sound counterintuitive, but it's all about inventory risk. The timing, there's a concept called destocking.
Destocking. Explain that.
Okay, imagine SPL. Back in June, they buy millions of dollars worth of styrene monomer at that higher price, $940 a ton.
Yeah.
They process it into their finished products, polystyrene, EPS, whatever. So now they're holding inventory of finished goods that cost them $940 per unit of SM to make.
Still with you.
But before they can sell all that finished inventory, the market price of the raw material, SM, suddenly drops to $800.
I see where this is going.
Exactly. The market price for the finished polystyrene, the product SPL sells, immediately starts to fall too.
Yeah.
It has to, right?
Yeah.
Because it now reflects the new, lower $800 raw material cost base. No customer will pay the old price if they know the input cost just crashed.
So SPL is stuck selling products made from expensive $940 raw material.
At a market price that's now based on $800 raw material. They essentially eat that $140 difference as massive margin compression or even a loss on every ton of inventory they made earlier and hadn't sold yet.
Ouch. That explains the profit collapse.
It's the biggest driver. And this mechanism, this fear of holding expensive inventory when prices are falling, it causes everyone down the chain, SPL's customers, the processors, to slash their own orders and try to run down their existing stocks. That's destocking.
Because nobody wants to buy today what might be cheaper tomorrow.
Precisely. They minimize buying until they think prices have bottomed out. So you get this rapid, intense downward pressure on demand and margins that just overwhelms everything else, even SPL's operational efficiencies.
So stepping back then, that brutal 39% profit drop, it wasn't really about SPL suddenly becoming inefficient or making bad operational calls?
Not primarily, no. It looks much more like they got hit by a powerful, essentially unavoidable cyclical wave driven by the extreme volatility in their key raw material price, styrene monomer. Hashtag tag outro.
So let's try and synthesize this for you, the listener. What's the takeaway here? We've really seen two competing realities playing out at SPL.
Definitely a tale of two stories. On one hand, you have this intrinsically strong company. Debt-free, market leader, serious about sustainability, and crucially executing a major strategic growth plan with that big 70,000-ton ABS plant. The long-term vision seems sound.
Right. But on the other hand, the immediate reality, the last 6 months, it's been brutal. Soft consumer demand, those policy hiccups, global uncertainty, and critically, that absolute killer blow from falling commodity prices.
Yeah, those factors just crushed the short-term financials. It shows that even a strong company isn't immune to the cycle. In the immediate term, the cycle proves stronger.
So those big strategic investments like the ABS plant, They need the market environment to turn around before they can really start paying off fully on the bottom line.
Exactly. The payoff requires some stability in commodity prices, and for that, consumer demand to pick back up.
Which I suppose sets up a really interesting scenario to watch over the next few quarters.
It does. The foundation for future growth, it's clearly been laid with this new high-value ABS capacity. They seem perfectly positioned to benefit when or if that cyclical upturn arrives.
So here's the final thought we want to leave you with. We know ABS is a higher value product intended for better margins, but it's still tied to that same petrochemical chain, still influenced by styrene monomer prices, even if less directly than basic polystyrene.
Yeah.
So the question to ponder is, how much stability does the styrene monomer market need to find? What level does it need to reach, and for how long before this new high-value ABS capacity can truly start to counteract the sheer force of these volatile commodity cycles on SPL's overall profitability? When does that long-term strategy finally start to win out over the short-term cycle?
That's the multi-million-dollar question, isn't it? It will certainly be a deep dive worth revisiting down the road.
Indeed it will. Until next time.